My name is Paul Vogt with PC Investment Bankers, and today we're going to talk about purchase price allocations in accordance with Accounting Standards Codification 805 business combinations. A purchase price allocation is a valuation exercise in accordance with Accounting Standards Codification 805 and International Financial Reporting Standards. The allocation exercise is completed after a transaction closes and is a very important part of a company's financial statement. More specifically, the purchase price allocation is a valuation exercise where the price paid for a company is allocated to all the assets that have been acquired and to all the liabilities that have been assumed. This may sound like a simple exercise, but actually, even determining the price paid can be difficult. Furthermore, you have to identify each individual asset, both tangible and intangible, as well as all the liabilities that have been assumed in order to allocate that purchase price across all those assets and liabilities. Once you have correctly identified each individual asset and liability, the fair value should be determined in order to allocate the purchase price to each of those items and then identify the residual value that does get allocated to goodwill. The challenge you face is that you don't necessarily have the time, the skill set, or the required expertise to perform a purchase price allocation correctly. This is where an experienced valuation firm comes in. This allows companies to provide accurate financial information to their investors. If a purchase price allocation was conducted incorrectly, this could lead to issues for the acquirer, which could lead to additional cost as a result of further audits and misstatements of their financial information. If the allocation process is not performed correctly, I would say it's a matter of when, not a matter of if, you will find yourself face-to-face with significant accounting issues. For example, if net income is overstated or understated, or if goodwill and intangible assets are improperly recorded, this could lead to significant issues. The structure of a transaction can be complex. Sometimes it can be as simple as just cash paid to the seller, but in many instances, a buyer and seller don't agree on the purchase price, so it may include an earnout. In many other times, it might be in the best interest of both buyer and seller to include that the seller maintains some equity ownership interest in that company, and that is often referred to as rollover equity. In all instances, an earnout and that rollover equity need to be determined in order to estimate the total purchase price that is being paid to the seller. As mentioned, determining the fair value of an earnout or rollover equity can be complex. These often require utilizing additional modeling such as an option pricing model or a Monte Carlo model. You may be asking, are there any shortcuts? Are there any simplified approaches to complete a purchase price allocation exercise? Unfortunately, there aren't any shortcuts that a company can take. However, in 2014, the Financial Accounting Standards Board did issue guidance that allowed private companies to make a private company election. Specifically, private companies who adopt the private company election are allowed to reduce the number of assets that are valued for a purchase price allocation. Some customer-related intangibles and non-competition agreements are excluded from the purchase price allocation assignment. Instead, these amounts will be included in goodwill. The reduced scope of work allows companies to save time and money because these assets will no longer need fair value determination. The private company alternative also allows companies to amortize goodwill over 10 years or a shorter period of time if supported. A purchase price allocation typically needs to be completed after any company makes an acquisition of another company. If you have recently made an acquisition, I would recommend that you reach out to your tax and audit professionals to make sure you are satisfying the reporting requirements. The valuation process can be complex and timely, and PCE would be happy to discuss your specific situation. Thanks for joining me today, and if you like this video, please subscribe to our YouTube channel so that you'll be notified whenever new content is posted.